Okay, everybody, it's Kevin Wadsworth and Patrick Karim, NorthStarBadCharts.com, and we've got a great technical analyst with us here today. We've got Edward Gofsky. If you're not following him on Twitter, you certainly should be. I know you took a little bit of a break a little while back, Edward, and reduced the number of charts that you're putting on Twitter, but I've seen you've been posting again a little bit recently, so it's great to have you on the show, and we're going to talk gold, silver, precious metals, and markets here. So where do we start? Patrick, where do you want to start?
Well, yeah, Edward, man, thanks for coming there. It's I've
No,
been
thanks for
following
having me,
you
guys.
forever. You're like one of my heroes of chart trading there. So it's a
I
huge,
appreciate that.
yeah. And I know
Thank
you
you.
don't do many interviews, so I was super happy that
Not
you decided to
really.
come.
Yeah, thanks, guys. I mean, you guys have put a lot of work in, and everyone in the gold and silver community knows you guys very well, and your work speaks for itself. It's very, very good, and I think a lot of the work that I do overlaps what you guys do. So there's always a lot to talk about because we're looking at the same stuff. And whenever I can give back, the reason I don't do a lot of interviews, to be honest, is I like to keep my psychology straight. So like if I'm talking to like 50 different people all the time, then I don't have enough time to do my own research, and it really affects. I don't want others. I don't want anything getting in my head. So like I don't watch CNBC or BNN, or like I'm just looking strictly at charts, volume, and like of course I get like notifications on what's going on, like macro, but that's just like headline news. I want to know the headlines, but I'm not going to read the article because I'm confident in my own analysis. But
Okay, so
for you
let's
guys, like, I always make time.
let's dig into that brain of yours then, Edward, and see what you've been thinking on.
Well,
Clearly, over the last few weeks, we've seen some very dramatic price action right across the markets. The S&P's broken down initially versus inflation, and then on its own merit has broken down. Nasdaq has also broken down versus inflation. And has broken down on its own chart as well, and same for the Dow Jones. We're seeing the equities charts now breaking down in a pretty major way, and there's a relationship, and I think you'll probably agree with this, the relationship between the stock markets breaking down, historically speaking, and what happens with the precious metals. And I just wondered if you'd like to explain how you see things going forwards over the next, year, 2 years into the future.
Yeah, that's a great question, especially like I feel kind of honored to like be on the program with you guys at like this kind of historical moment. I mean, the news flow in the last week has been like unbelievable. So when you're talking about this chart that I've been posting, I've had this chart up. This is like a Elliott
yeah,
wave count starting from the bull. So my interpretation, I'm not going to get into like explaining Elliott wave. I mean, there's so much resources out there for people to, that's free, that you can learn wave counts, and a lot of it is not just technical analysis, but a lot of it is psychology. And Robert Prechter, who's like basically brought Elliott wave theory out of into the mainstream in the early 80s. He took Ralph Nelson Elliott's works from the 30s and sort of expanded upon it. So my thought is this bull cycle that ended in my opinion, it ended in 2021, or like the Dow, this is a Dow Industrial. This peaked in early 2022. And yeah, so we've been sort of looking for like a fifth wave blow off top. We thought the blow off top actually was like where the COVID was. So when you go back to like where the fourth turning started, yeah, right there. A lot of people that I follow in Elliott, like we had that as the blow off top. And so we were pretty convinced that it was. And the good thing about that is we were selling way, like anticipating that that was the blow off. So before COVID, we were pretty much like liquid, mostly cash and stuff. And then when it crashed, obviously, like when the government came in, they really had no, I mean, I don't want to debate if what they did is right or wrong. Obviously, I think it's terrible, but you're seeing the consequences of the printing now. Like everybody likes the early stages of inflation. This is a very, very famous saying, but everybody always likes the early stages of inflation because asset prices go up and everybody feels wealthy. It's like a positive wealth effect, but they don't think about the consequences. Like nothing is free, right? So when the government gave out the stimulus money, everyone's like, oh, I'm going to buy crypto, or I'm going to buy XYZ meme stock or NFT. But now you're seeing like inflation is high. the government has no choice but to like jack up rates to stop people buying energy, because that's the real problem. So like so getting back to like, we thought it was a fifth wave blow off top, but when you see that they injected $20 trillion into the system to like get people out of the COVID or get the economy out of the collapse, basically like it created the final fifth wave blow off top. So like basically they just printed the blow off. So that's why you saw like at the end of the fifth wave, that's basically where Bitcoin was at 69,000. And so you could just see like, if you look at history, especially like when I'm talking about like the 1960s go-go tech boom, like if you go back and read like some of the money pools that were put together in technology, it sounds exactly like Cathie Wood's like ARK Fund. There's a lot of other like Michael Saylor. There was a lot of guys like Michael Saylor like in that go-go 60s, way more than the tech bubble of like 2000 in my opinion.
Wow.
So yeah, that's just like kind of how I look at it. So it does, obviously at this point now, it looks like the fifth wave blow off top has been like hammered in. And so you see why I put peak liquidity, right? And so like you could tell there was just so much liquidity. Like I remember I was in Mexico, in Cabo, right when Bitcoin hit 69K, and like a couple of days before it hit, I don't know if you guys recall this, but remember when Tesla, there was a news article about like Hertz rental car was going to buy like 30,000 Teslas to do like rental cars. It was like a scam post, but like Tesla was up 20% the next day, and then Bitcoin went nuts. And like that was the final blow off top. Like that's how crazy it got, where like it was a bogus news release, but because the psychology was like, and the money was there, like that's when I took time off. Like I posted like, I'm going to stop because it didn't make any sense to me. And like, that's why I sold everything. Like I've been cash for a long time, because it just didn't make sense how like NFTs, crypto, the blow off, and then all this other stuff. And yeah, so it looks like it's hammered in. The problem now when you're talking about like gold, because if this situation is like similar to like, you guys have been seeing the posts I've been doing with the analogs. It's not just me. Like I get it from Nautilus Research. So like Nautilus, I want to give them a big shout out on the show, because like I always tell people like I'm kind of like standing on the shoulders of giants. Like I'm just extrapolating on other people's work that sort of correlates with mine. So there should be, yeah, it's just up a bit, I think. That one has been really famous, but there's other ones that I thought I posted a little bit earlier. Yeah, that one there, that one right there. That's Tavi's work. That's a big deal here. This is Tavi Costa. You guys know Tavi.
Yeah.
Yeah, me and Tavi are like so similar. Like the guy is obviously very intelligent and he's a super smooth talker. And so like I like that. He's very good at like promoting his work. And his charts are like just really good. So anyway, this is I talked about this yesterday on StockTwits, where I posted Tavi's chart, and I was like, I don't want to like dance on the grave of like the dead bulls here, but like this is a big problem if you're bullish. Like this is like really bad. Like this is classic technical analysis, like Dow theory. So like if you're a bear, you're like laughing, like because this is like best case scenario if you're like shorting the markets here. But if you're a bull or like a long-term buy and hold investor, like a regular person that's got like a 60-40 portfolio of like stocks and bonds, like I don't know, like it's going to be a big drawdown. I know that. Like, I don't know. Like, there's just so much to say about like the indexes are pretty much like, I don't know how it's going to be years before they get to new highs.
I was going to say, would you agree with the idea? And myself and Patrick have been looking at this for a while. That regardless of, I mean, clearly the stock markets are breaking down. But the fact that they're breaking down versus inflation, we have stubbornly high inflation, 8, 9, 10% across the states and across across the the European nations, and with that kind of inflation rate and stock markets heading south, all of this is accumulating month by month. The difference between the cumulative effects of inflation and the actual nominal decreases in the stock market, basically looking historically back to how the breakdowns occurred in the past, and you know there've been two major ones in the last sort of 50, 60 years or so, then you can sort of speculate that it could be anything from sort of 12 to over 20 years before the stock markets actually recover, when you take inflation into account. So to my mind, that is, you know, a large factor in this sort of rotation of capital that takes place. You know, it's you can pull up ratio charts to your heart's content, but all you really need is precious metals versus the S&P. And once you realize that the money is flowing away from general equities, you have to find out, where is it going? Where's that money going? You know, it's clearly being pulled out of the stock market. Stock market valuations are falling, and there are more sellers than there are buyers. I mean, that's how markets work. So if that's the case, then those funds, you know, the smart money that's getting out early and that knows what's coming, hedge funds and the well-connected and the wealthy, and you know, the people that aren't going to end up as bag holders, basically, you know, they're taking their money somewhere else. You know, are they going to cash? Are they putting in currencies? Are they taking it into commodities, precious metals? And you know, you can pull up one ratio chart after another, and you can soon find out, you know, where that money is starting to leak. And really, there are a lot of markets, like, for example, you know, specialist niche markets and commodities. I mean, the precious metals market is small compared to the S&P, but I'm thinking of things like uranium here, for example. There's a very strong bull case for uranium. You probably seen our charts. But what I'm getting at is that this huge amount of money that's being pulled from the stock market, it only takes a small percentage of that to leak into these alternative markets, if you want to phrase it like that, to get enormous, and I mean enormous gains. You know, looking at what happened the last time gold broke out versus the SPX, it went up 8 times. 2000 from the breakout at $300 up to around about $2,000, and the same thing happened from 1976 to 1980 during the second stage in the 1970s bull run. It went up by a factor of 8 times, which is either just a coincidence or it's, you know, something to keep an eye on. But you know, when people talk, you know, when you hear me and Patrick tossing around numbers like $10,000 gold and $12,000 gold, people think you're completely crazy, and they conveniently forget that between 2000 and 2012, that's exactly what it did. So how is it crazy to expect, you know, gold to move 8 times? I mean, that move from $1,000 to $2,000, that was a 100% move for gold, and it hadn't even broken out versus SPX. It was in a bear market versus SPX, and yet it still managed to go up 100%. What do you think is going to happen when gold actually does break out versus SPX? I mean, I'm not saying it's going to break out this month, next month, or the month. I'm not presuming or suggesting when gold is going to break out versus the S&P, but that is for me the key metric to watch, because when it does, Patrick will get his moonship out like that, and he'll be justified in using it.
That's good. You're making me blush now. You know, that's good.
So yeah, so what I mean, what are your thoughts on that? I mean, it's sort of, you know, these large valuations for gold.
Yeah, I mean, it's going to happen eventually. Like a lot of things, like you saw the chart that I have pinned to my Twitter channel, right? So, you know, the chart, it's almost, when you look at it, the author of the chart, like he almost got it exactly, because like gold's gone down like all of 2021 pretty much, and then into 2022. So he said that it was in 2022 it was going to go up, but I mean, like like the way I look at it is, you know, the reason I pinned this chart is so it reinforces in my own head that like wait till 2000 breaks out, like wait till 2000 breaks out, because the thing is, when you have a head and shoulders pattern that's like 10 years in the making, when you're carving out that right shoulder, which is like what we're doing right now, sometimes obviously there's a lot of chop, and it's going to take maybe 3 or 4 years to like actually form the right shoulder before we actually break out above the neckline zone, which is like there around 2000. But you know, I've got like 2100 as sort of my key area where I'll start unlocking like a lot of my cash to like get involved. Because the thing too is like people are afraid to like miss, because it could happen at any moment. I talk about this when I post my monthly gold chart. So that's coming up like next week. I'll post it. So it's a monthly close, like from 2001. So it's like a 20-year monthly closing chart of gold, and it looks really bullish. But you have to be patient and wait until like the buyers come in around 2100, because at that point, like once it breaks that, like can you imagine like Twitter and stock twits and like I'm not a Reddit guy at all, but like obviously I know like Wall Street Silver is on Reddit, and also like they're doing a lot of other work on like YouTube and stuff, which is great. But it's gonna go bananas, and that's gonna sort of feed on itself. So yeah, I for me, like obviously like you can make like 10x gains like once we get over 2100, then like sky's the limit, right? So
Yeah,
the more
I think a common mistake that people make is to try and catch the bottom and try and sort of think that they can catch this falling knife, when you can actually reduce the risk by just catching that central portion of the move. If you accept the fact that catching the very bottom is a very risky business, and you can end up, you know, having your capital tied up for not just a risky business from how much it might drop further, but how long it might take. I mean, we could have been chatting a year ago thinking, right, okay, it's bottomed and it's moving up again, but it hit that 2000 level and then retreated. So all this time is passing where you can have your capital invested elsewhere. So it's much sort of more logical to actually make that investment, or the bulk of that investment, when that threshold is crossed. So I agree with you. You know, that sort of 2100 level. I mean, we reached 2075, I think, didn't we? So 2100 makes a lot of sense. And that once that threshold is crossed and closed above, then you're going to get the strong trending move. Anything before that is not really part of the strong bull market trending move. It's got to be confirmed by a number of factors, the breakout versus SPX. Yeah.
So just guys, hold on 1 second. I gotta just grab I gotta put a charger into my laptop. Just hold on 1 second, okay? Just hold on half a second.
Yeah, no problem. Yeah, that chart, Kevin, you know what it reminds me of? Some of the charts you did back in the days there with
yes, I can dig one out that looks very much like that, Pat.
I'll have to check out Stuart Thompson. I've never heard of him there, but
yeah, Stuart Thompson is the author of the chart.
Yeah, that's exactly. We're gonna have to reach out, because look, it's chart trading people, they think it's mystic, but look, he was able to draw that because previous past behavior gives you probabilities of what's going to happen in the future. It's like the bag holders here, previous resistance. Now, you know, people sold back here. So there's a chance that the people who sold back here, they're still around, you know, if they didn't sell at the bottom. So of course, this is a natural place to pull back, right? And after that, you're on top, you retest support, congestion area. It's like, it's not rocket science. And
there's only one of two things that's going to happen here. And it's either that right shoulder builds out and the move happens pretty much along those lines, or the whole pattern fails and we go all the way back down to around about $1,350, $1,400, or even where Patrick's just drawn it there. So, you know, that there's really only two options from here, and there's a number of key pieces of evidence that point to which one is the most likely.
Yeah, but that's what gets back to what we're talking about, where it's worth it to wait to see like where it's going to break. Because like, if it's very possible that like it's a super bad liquidity crisis, which is what the markets are kind of saying. And actually, you know, the craziest thing, I just want to say this like before I forget, but when I was driving around last night, I was driving around Vancouver, like tying up loose ends, and I got the notification from like Wall Street Journal that like the UK government is going to do tax cuts. And I like almost drove off the road because I was like, that's for sure. I started laughing. I'm like, that's got to be a misprint. There's no way they're going to be cutting taxes and like getting rid of all whatever monetary policy hiking cycle like the UK is trying to do. Like, that's why I was like, when I saw that headline, I was like, it's game over, because they're showing their hand. Like, they don't care about it. They're going to let inflation go, right? So like,
well, the idea is to, I suppose, increase GDP.
Yeah.
So
like when I saw
that's one sort of way out of it. If you can increase GDP sufficiently so that the debt to GDP is manageable with higher rates of inflation, but it seems to me like an inflationary move in itself, given a little bit of time.
What like, from what reading I've done since I got that notification, basically is like, So when you're doing the tax cuts, it's going to undermine monetary policy because that's a fiscal move, right? So the government is enacting fiscal policy, so they're cutting taxes because it obviously there's many reasons why they want to do that. Maybe they want to like get elected next time. They're like kind of buying votes, but also like everyone understands like the cost of living crisis worldwide, but especially in the UK and especially in Europe. So they got to do something, right? But if you're fighting inflation, the worst in 50 years, and you still have 5% negative rates, and then you cut taxes, like the reason the market is tanking is because now they know that the government isn't serious about fighting inflation. So it's going to take longer to like get the inflation genie back in the bottle. That they might get rid of it, but by cutting taxes, they're delaying, like they're just pushing it off. And so that's bearish, right? That's like really bearish because you're going to let inflation fester, right? So
well, I think inflation's locked in for quite a while. I mean, you only have to look at European PPI and what's happened to Germany's PPI. I mean, it's pretty much off the top of the chart, and it's even if it fell substantially, it would still be way above targets. And that kind of persistent inflation with a struggling economy is the kind of backdrop that precious metals thrive on.
Exactly, which is getting back to the point where we were talking about before, which is the frustrating part. And so I talk about this from time to time when we get these like macro bullish factors for precious metals, but the precious metals aren't reacting. Like yesterday, they got slammed because the liquidity, like there was a lot of margin calls, obviously, like within the last week after FedEx, and now you saw the last couple of days, especially yesterday. But yeah, I mean,
we're recording this at the weekend. It'll probably go out on Sunday. We're recording on Saturday, fairly late on Saturday.
This is a popular.
I'm just speculating what we might see next week. You know, could we see a real spike down next week?
Yeah, I think so. Like, you know, I'm like a podcast. Like, I get all my information from podcasts. So like, I listen to you guys when you guys are on like Palisade Radio and all these other kind of programs, which is awesome. And I mean, yeah, they're getting back to like the gold and silver situation, like why it's not responding. I always tell people there's a famous Jesse Livermore quote where basically he's saying like, sometimes the market takes its time doing what you thought it must do. Cause like everyone's that's in the gold community is like 50-year high inflation, the market is crashing. But it's the reason it's not, the precious metals aren't going up is because it's a liquidity problem, right? Like there's a reason, like once Bitcoin was down below like 40K, I'm like, there's a big problem here. And that was like at the beginning of the year, like that was January. And then after that, you saw like, I think it was Netflix was the one that came out with one of the first negative earnings calls, and they were like cutting.
Oh, did we lose Edward?
I think we might have lost the camera feed temporarily there. Is he back yet?
I'm here.
Yeah, you're back. Yeah, the camera froze for a moment.
Oh, sorry.
It's okay.
How's that? Better?
Yeah, I can hit. We got you back.
Awesome. So
there was one thing last week that held up quite well apparently, and it was orange juice. Don't know if you saw that meme there with Joe Biden in it and all the red tickers behind him. There was another one going around that showed a green one in the middle, and it was orange juice.
Oh wow!
made me chuckle. So
I love orange.
Crisis. Everyone's flocking to orange juice.
Yeah, I love orange juice because, like, obviously, like as a Wall Street nerd, right? Like I've seen all the movies a million times, so everyone always talks about like orange juice. When you're talking about the Eddie Murphy, Dan Aykroyd movie.
Yeah.
And so that everybody loves that movie because like, you know, the whole plot is basically like they have to get the information on like, is the orange juice crop frozen or whatever. So like when you talk about OJ with like a Wall Street guy, he's always going to smile because it always comes back to like whether Eddie Murphy and Dan Aykroyd are in the pits, like trying to buy orange juice futures. So like, it's crazy. But
there you go. It was up 1.5% on Friday when everything else was tanking.
Yeah, except for all the inverse ETFs, right? So like I have, right? I'm like 99% cash, but like I always like to try to like short the market at times like this, just like to see. It's really super difficult, obviously. Like I would never recommend anybody try it, but I've been around. I was around in 2000 and then 2008, especially which is why I've been posting more recently, because I'm like, man, this is like so, it's so similar, like it's almost crazy. And that's why the patterns are like so similar, because it's not, people think like, okay, it's like buying and selling, but like it's human nature, right? So the psychology of mania never changes. It's the same as like 29 or 66 or 87 or like 98, or you could just go through the history of Wall Street and you can see the same patterns, because it's still human beings buying and selling. And you know, like when you get into a mania like that, like the patterns should, if the theory holds that like buying and selling is just psychology, like extrapolated into like sort of graphs that you can look at and monitor. I don't know, like to me, it just makes a lot of sense that like we just saw one of the biggest blow-offs. I mean, I don't know, like when one of the main indicators, you know, when the Staples Center in LA became crypto.com.
Oh,
and
boy.
I was like, that's the end of it, because I'm a big sports guy. I'm a huge NHL and NFL like nut. And like, I kept having to listen to like sports shows go on and on about, oh, the name changed to crypto.com. I'm like, there's no way this can go on. Like, is everything going to be crypto? And then right after that, that was the top, right? So
yeah, look at this one, Edward. The fractal. Just I'm inspired by the ones like, look at it's textbook stuff, man. It's repeating.
Yeah, I like that. You guys, I like the software that you guys are using. Both of you guys, like that's really awesome software. And you know, Patrick, like this chart that you're doing right now, where you're extrapolating like the 70s over like what's going on now, like an analog, like it definitely makes a lot of sense. And there's a lot of people posting similar charts about you know, the bear markets, especially the 70s, but even in the 30s. You saw the chart earlier, like the 1937 analog to like current time. So 2022 and 1937, it's like very close. And then you've got the other analogs like 2001, it's very similar, 2008. And it's basically, what that means is like the psychology is the same. So in all of those bubble tops, you had manias and all different kinds. Some of them are similar, like 1966, 2000, and like to 2021. It's all tech based, right? So like everything is like new and like digital and all that, but it's happened before. I remember in 2000, it was like unbelievable. You're like, oh, the future is so amazing. And then a lot of it was just advertising money. So like the tech companies are raising money in Wall Street, and they're spending the money that they're raising on advertising. So it seems like these businesses are doing well, but it's just advertising money, right? And so like that's why you're not seeing a lot of crypto ads this year, because they ran out of money.
I'm just thinking for everyone that's watching now, and they're probably wanting a little bit of guidance at these, you know, this sort of difficult time. You know, if you're holding precious metal stocks, you're feeling wiped out. So what would your advice, Edward, be to firstly to people who are holding at a loss, and secondly, what would to your advice to people that aren't in precious metals yet? So two sets of people. If I'm someone who's holding at a loss, what would you tell me?
Yeah, you know, that's a great question. That's actually why when Patrick reached out to me, I actually like really wanted to come and talk to you guys, because like I've been at this point.
Oh, crucial moment.
Right before the answer. Hold on. Hold on. You froze right when you were saying the answer.
Did I? Okay, no, that's okay. How's that? Is that better?
Just a crucial moment. You just went off there, but you're back again.
Yeah, no worries. I can just, it's in my head like forever, like that 2008, like what happened in gold. It's like an amazing story. But so I was like heavily invested in 2008. I had like call options on Gold Corp, and I sold those call options for like, I don't know, like it was like a 5x return. Like I sold it the day after Bear Stearns went bankrupt. So that was like March of 2008. So I thought I was like, oh my God, I'm so smart. And I've been following gold since like 2001. So like, I thought I knew like how gold should react in like macro environments. And then when the summer of 2008 came, just before Lehman Brothers, I already sold those options, and I took the money and I took it out of the market, and I did other stuff with it outside of the market. So I didn't put the gains back in, but I still had a lot of money in the gold sector, because, you know, everyone was saying like, okay, like Bear Stearns went bankrupt, gold's going to go ballistic because the banking sector is just gone. So the theory sounded good, but by the time like August of 2008 came, liquidity started coming out of the markets, and like it's in my mind forever because I have all the charts in my desk somewhere. Because that back then, that was before Twitter and all that, so I was keeping like hand charts that I'd print out. And once like the GDX broke in like the late summer, and by October when Lehman Brothers went bankrupt, and a lot of the gold stocks, the Barrick and Newmont and Agnico Eagle were down like 60% from like, I guess like March of that year. So it was like I felt so bad, and I feel like how I can imagine how other people that are holding right now, but obviously like there's going to be a time where I don't want to talk about a Fed pivot, obviously, because like it's like a catchword on Twitter and like social media, and I don't think they're going to pivot at all because like they see what happened when UK cut taxes. Like they know that like you can't do that. You got to like let inflation. You got to fight inflation with higher rates. But eventually, like gold and silver, you can see the patterns. Like the patterns are long-term bullish if you're looking at it for like more than, I'd say, like a 10 to 20 year pattern. And so once we break over the 2100 level, that's like a full green light, right? Because you can put your stops in really tight. That's what I like. But if you're holding right now, like I can't imagine, like, say, let's talk about like where silver would be, like if it gets down to like 10. Because if you guys remember, like in the 2020 crisis, it got down to $10 like for like a day, and then it came right back up. So I mean, yeah, I if you're holding now, like I wouldn't add anything more, but I mean, I can't imagine gold going to like 15 or 14. It would have to be like a major liquidity crisis. That would be what I would say to somebody that has commitments at this moment. So yeah, like I've been there myself. Like it's not gonna keep going down forever. Like this is the good thing about gold and silver is like the mining companies that are pulling the like hard money out of the ground. Like silver is never going to go to zero. Gold's never going to go. Like, can you imagine if gold went below 1,000? Like that would be an amazing buying opportunity. But I mean, I just don't think it's going to get there. So if you're holding now, I wouldn't be too concerned as long as you don't have like too much of an allocation. But if you're somebody that doesn't have a commitment, then like just wait till gold gets over 2100. Like there's really nothing else to really do. I posted this like a couple, maybe a week ago, and I'm like, I'm watching it every day, obviously, but like nothing's happening. So like in the meantime, I rather just like focus on like shorting the indexes and like just having cash and like focusing on other stuff. Like I have other interests outside of like Wall Street, like that I'm focusing on. But like, yeah, I mean, until gold gets over 2100, there's really nothing to do, really. Like just keep following the charts, and once it breaks out, then you know, if you've done the work, then you have your stops, your buy stops all set in. Like yeah, like that's the best part about the setup with gold and silver, but especially gold. Once it breaks over 2100, you could put your stop in at like 1999 or like 1950. So you're not, the reward is huge. It could go to like $3,000 quite quickly, but that's the allure, right? Everyone's doesn't want to miss out on that. But like at this point, I don't think it's gonna happen overnight. Like even if gold jumps up $100, it still has to break out over 2100. So, but that's it's the best long-term setup. Like obviously, that 20-year chart of gold with the big head and shoulders bottom, and then you guys know like the silver chart, the what is it, the 50-year cup and handle. I posted this a lot in 2021 when I was like, I really thought, like everybody thought, I was very, very convinced. But when gold didn't break out over like when silver didn't break out over like 25, I think it was like in July or something like that of 2021. I'm like, oh man, that wasn't a good sign. But yeah, I mean,
that pattern is still building out, of course. We've now got a cup and a smaller cup, so it's a huge 50-year cup
like a fractal,
with a smaller one embedded on the right-hand side of it.
So exactly. That's fractal.
It's playing out nicely, and it's interesting how the March 2020 COVID low created a spike that created that little cup, and basically is responsible in a way, from a technical point of view, is responsible for what we're going through now, because it's created this extended time period where there's greater scope for downside. And the same with the gold chart as well, for that matter. So the price action, as it's gradually built out over time, has created this sort of floor that is just beneath us now for the gold and silver price on the long-term charts that has just extended sideways. And as you say, you know, in terms of silver, until it gets above that sort of level, somewhere above $30, there's probably not a lot to do. I mean, it'd be pretty exciting when it gets above $25 to $28.
Oh
I think
yeah,
there's some key resistance there.
I think so.
But certainly once silver starts breaking to new highs, I mean, goodness knows where it's going to go. But same as with gold. But I think that is really sound advice for everyone that's watching this. And you know, I think I would tend to agree with that. And you know, along with confirmation charts that back up what's happening when gold does actually make that break, if it's breaking out versus SPX, if the gold silver ratio is breaking down, if the 30-year yield divided by the 10-year yield is breaking to the upside, all of these sort of charts that go alongside, and gold outperforming commodities as well. You know, that's starting to be the case already. Don't know if you'd spotted that one. Gold is now starting to, yeah. So and of course, you know, before all of this happened, gold moved up to $2,000 and it put in its big run, and then people said, why is gold not doing anything? Well, it already did do, and then commodities followed, so gold started to underperform commodities, and now that has flipped again. The script has flipped, and gold is starting to outperform commodities again. So that is another key indicator as to the tide is turning yet again.
I think so. I think I know the copper stocks got just hammered yesterday, and I wrote about like Freeport McMoran. I'm like, if Dr. Copper needs to go to the emergency room right away because he's like, there's something wrong like with the economy. You know, everybody knows like Dr. Copper is like an indicator for the health of the economy. Well, if that's true, then like the economy is like really sick, like terribly sick. So that goes back to like, you know, why it's a liquidity problem right now. Like from what I'm looking at, that's why I'm thinking it's very similar to like the fall of 2008 and not the spring. Because I sold my Gold Corp call options in like March of 08, and I thought it was like hot stuff. And then like 6 months later, all my other gold stocks were like down 50%. And I was like, what's happening? Because macro wise, like Peter Schiff that year was right on everything. He's like, this is a banking crisis, banking failure. Oh, Peter, you're crazy. And then everything happened. But then he was he's not promoting, he's like recommending, like, you know, maybe you should have some allocation. And then they went down so bad. But in the end, obviously, like when the Fed got involved, that's when the liquidity came back. And then between 2009 and then when silver hit 50 in 2011, there was like huge gains to be made. So it goes back to like, if you're holding, like the gains possible to be made will make up for the drawdown that you're having currently. And then if you're not involved, when you break over 2100 in gold and like say 24, 25, 26 area, because once say gold could break out to 21 and silver could still be like 23. But at that point, you know, silver is going to go, right? Because sometimes it lags. This is the thing about gold and silver, is like sometimes gold leads silver, or silver leads gold, or the stocks lead the metals, and vice versa. This is like a common topic. And so, yeah, like it's important to pay attention to all three, like the stocks, the metals. But like the one thing I want to say before like we finish this recording is like the reason I pinned that 10-year like head and shoulders like reversal bullish formation in gold is the formation is telling you like something is rotten in the system. So I posted that chart in 2021, early 2021, and I was thinking to myself, like, there's something really wrong here with the economy, because this gold shouldn't look this bullish if everything's okay, like what they say, if you're listening to Wall Street. And then that's why I kept it there, to remind myself, like, I think I talked about this with you before, Patrick, like the reason I got onto Twitter is like not to get famous or like to like brag about like how I have this like obsession with Wall Street or whatever, but it helps me sort of focus my thoughts and keeps, it's like a diary, like like where I can like go back and like it's good for myself because it reinforces my own sort of the way I look at Wall Street and the way I do my like analysis, and it really helps me. And if people like it, then like it's super awesome. But like, yeah, I'm doing it mostly for just to keep myself, my own psychology straight, and it seems to be working. And that, you know, it's nice to know that there's other people out there that have like a similar point of view.
Yeah,
And
and it's all about sort of gathering that weight of evidence and looking at the technical chart work that other people are doing, and that's where the ideas come from. I take on board what you're saying about not getting overly sort of lost in other people's thoughts and ideas and what's going on in the fundamental background and all the news stories and all that kind of stuff. But certainly the sharing of ideas, whenever me and Patrick have a Zoom call, we kind of spark all these ideas off each other, and you end up sort of suddenly going down a rabbit hole that you hadn't even thought of before, that kind of you add to your sort of arsenal of charts that you can refer to. So it's all about that, having that confidence level.
I agree. So it's different though, like when the three of us are talking, because we're like, when I tell people, I always tell people I'm a technician first, and then obviously like, because all the books I've read, like I've read almost every single technical analysis and like Wall Street psychology book, is like when you're looking at like see like the thing, I'm going like, my mind is like racing there, so I had something there and then I lost it.
I do that all the time. I do that all the time. It's a sort of senior moment, especially when I'm drawing charts. I can start drawing a chart and then suddenly forget the point that I was trying to prove.
I know what I was going to say. So like I know what I was going to say. So the reason I like to, like when we're talking, I don't, like when I say I don't listen to the news and like I don't have CNBC on in the background when I'm doing my research, and I do most of my stuff from my cell phone, to be honest. Like the cell phone, like I have an iPhone, it's so advanced. Like I do all my people are pretty amazed. Like I do most of my posting and all my work and everything like that, and all my note taking and research, like basically on my phone. And like when I do calls like this, then I get on my laptop. But like I learned a lot, because like in 2021, I was posting so much, and I was like, I didn't sleep a lot, because I'm like, oh, gold and silver is gonna just rocket when they're like printing out. And even Bitcoin, before, I was a big Bitcoin bull when it was in the bull market, and it was crazy back then. But I had learned a lot, because like when I got really frustrated last year, like in October, when Bitcoin, like it hit 69K in November, but I was in Mexico at the time, and I felt so bad, because I'm like, I'm so confident in my own research. I'm like, I know that what I'm talking about is going to happen, but it took so long, because when Patrick and I talked last time, it was like summer of 2021. So that was like 4 months before Bitcoin topped. So for like those 4 months after, I was like, really, and then at that time, remember, gold wasn't moving, but Bitcoin was going nuts. And then everything was NFT, and then all the money on Wall Street was getting funneled into crypto, because they were making money.
Thing is, when you see people paying $1 million for a picture of an ape, something's approaching an end.
Exactly.
I might be a little bit old-fashioned, but that struck me as something akin to tulips.
Sure, but this is what gets back to, like, when you're talking about Elliott wave from a psychology standpoint, not just from the wave counts and like even classical technical analysis, where you're looking for like blow off arcs and all this kind of thing, where like, yeah, I mean, I was like, okay, so I had the Elliott count that you guys talked about, and so I was looking for a fifth wave blow off, and then you have all these like headline stories about, like we talked about, like the crypto and the NFTs and all that. I'm like, wow, it couldn't get any better from a Elliottician standpoint, where you've got the terminal wave count, so the technical analysis is saying that it's a blow off, but then you have all the psychology around what's happening on Wall Street. And with not just Wall Street, it was like pop culture. You had like athletes, actors. Remember Matt Damon? Like there's so many memes now of like, I think it was, I don't even know if it was crypto.com that paid Matt Damon, or, I mean, there's a lot of actors and actresses and athletes that got caught up in the crypto. They didn't know anything about it, but they're like, hey, we've got like $20 million from this fundraiser that we did on Wall Street. We'll pay you like $5,000 to talk about it. And at that, like when that stuff was going on, I was like, this just can't go on. That's why I got so frustrated. I'm like, I'm just going to stop like posting for a while, and like, let's just see what happens. And then right about 2 months after that, like January, then everything started unraveling. But even in my wildest dreams, like I wanted to make this clear, like I never thought that crypto would have this kind of like downfall this fast. Like it's actually like, I actually feel pretty bad, because
it goes back to what you said before. Knowing what is coming is one thing, but the timing can be something else. You know,
Exactly.
your theory, technical charts very often take a little bit longer to play out than we at first anticipate. But that's where, having very clear lines in the sand on a technical chart and very clear rules of the game, a little bit like Stan Weinstein, sometimes it just makes it very simple. Sometimes you can overcomplicate things, can't you? Sometimes, and just keeping it simple is often a way out of the confusion.
Yeah, Stan Weinstein's book is great.
Yeah, and like you, when I saw Bitcoin coming down below the 40K level, that's when I posted a warning on the website for our members, and I said, look, Bitcoin warning, breaking down below critical support. And you have to hand it to the guy, and you have to hand it to these people who, as you say, we're standing on their shoulders, because they've given us all this work to benefit from, and it's the starting point. Back in those days, of course, they're doing it on bits of paper and drawing their charts with bits of data that came from goodness knows where. They didn't have the technology that we've got now. So hats off to them. And anybody who hasn't read Stan Weinstein, I'd thoroughly recommend it. I think we're probably gone towards the hour mark now, so we'll probably draw an end to the interview, draw a conclusion to the interview. But I for one, always appreciate listening to your thoughts, Edward. And
thank you very much.
You're a great technical chartist. And before I started doing all of this, I was looking at your stuff and admiring the charts that you put out there as well. So
thank you very much.
Yeah, no, really appreciate it. Do you want to tell everybody where they can find you, what your Twitter handle is?
Yeah, so my Twitter handle is just Edward Gofsky, at Edward Gofsky. And then I'm also on StockTwits. So I feel like in the last year, like obviously my psychology is like flipped upside down, because like things were going my way last year, like in the way I was doing. And now everything is sort of like, I feel like I have like a real feel for the market and like what's happening. But I post a lot on StockTwits as well. And that's kind of like, if you go into my StockTwits, I'm more, I look at it like as Twitter after dark, like they let you post. Patrick knows about this, because we're on it all the time. We see each other's work on StockTwits all the time. But StockTwits they have you can write way much more than you can on Twitter. So sometimes I'll post stuff on there, and I'll post charts that I might not post on Twitter, because I like to keep my Twitter channel like, I like to keep it looking like, I'm not saying like there's a difference between looking nice and not, but I'm more open up on StockTwits. So you can find me on StockTwits at Cup and Handle Charts, and it's also Edward Gofsky, and then Twitter is the main part. But if people are interested, they can catch me on there, and you can send me any like DMs if you have any questions, because I post stuff for myself, so I don't really look at like all the comments. Sometimes I post stuff and there's like 100 comments, but like I don't read the reason that I built my channel up to like 23,000 plus followers is like I don't really read a lot of the comments, because I'm doing it for myself to help myself sort of learn more, right? And it helps reinforce my thoughts. But Twitter is the best place, and StockTwits. And I really appreciate you guys having me on the show.
As I say, always great to have you on the show, Edward. Both Pat and I really appreciate it.
Anytime for you guys. You guys are awesome.
It was an awesome treat just listening to you, Edward. And let's catch up when gold goes to 2,100.
Hey,
anytime, 2,100, we'll have you back on the show.
Well, when that happens, it's going to be bananas. So like, I have good Wi-Fi in El Salvador and in Mexico. So if I'm down there when it happens, like we can hook it up, and it's going to be fun to see. Like something's going to happen. Like either way. Like, but the one thing I'll say is I have a lot of like limit order like call options for like silver, SLV, and like GDX. So like basically, like if GDX ever got to like 10 or 15. I'd like to get some like 2025 like call options on those, because like it's not, the GDX isn't going to stay down below, like if it ever gets below 20, it's not going to stay there very long. That I know.
Yeah, be a quick spike down and then sudden reversal. So make the most of it whilst you can. Okay, Edward, it's great to talk to you again, and
great to talk to you guys.
Look forward to speaking to you again in the future.
Absolutely. You guys take care.
Ciao, Edward, man.
You too. Bye.
Bye.